of Market Insights. I'm Kelvin here again. Happy Friday and very good morning. Today will be the 28th of June 2024. So before we start our daily dose of Market Insights, let's have a quick look at the disclaimer first. All right. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or any recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so before we jump straight into the short-term intraday technical outlook on the broad-based cross-asset classes, that means ranging from the four major dollar pair, the major stock indices, and two key commodities market, the gold XAU/USD and as well West Texas crude oil. Let's have a recap what has taken shape yesterday in terms of the cross-asset price action, news event, and as well as related economic data releases that has been released overnight and as well as in today's Asia session. Okay, let us start with the performance of the cross-asset classes overnight first. So first and foremost, we do see a very firm positive intraday outlook on the major US stock indices. So what we could see over here is that all the four major US stock indices managed to actually close in the green, but the most startlingly was the Russell 2000, which is up by positive 1%. The rest of the the rest of the major stock indices, I would say that it's the gains are not that great, rather minute, where the SPX only closed up by 0.09%, the Nasdaq 0.19%, and the Dow Jones Industrial Average very similar minute pace as the S&P 500. Only positive 0.09%. So if you look at the intraday movement over here, it's rather sideways, I would say, but towards the end, it still managed to inch up a slight gain for the S&P. And if you look at the Nasdaq 100 performed slightly better, positive 0.19%, whilst the Dow Jones Industrial Average managed to actually close slightly higher after initially trading near the intraday lows during the middle part of yesterday US session. So if you look at the heat map of the S&P 500 very quickly, so what we could see over here is a rather more greens than red overall over here. But what's interesting over here is that we see the mega cap stocks, all of them are actually managed to actually inch up much higher, with Amazon positive by 2%, Meta positive by 1.25%, Google, Alphabet positive 0.8%, and Apple 0.4%, and the slight gain of 0.15%. 0.15%, pardon me, for Microsoft. So that actually able to offset yesterday's intraday underperformance of this all-important or influential AI chip leader, NVIDIA, which closed in the red at negative 1.9%. So actually that explained to us that the other mega cap technology stocks in the US, they managed to caught the negative feedback loop from NVIDIA, which is positive in terms of the sentiment. So later I'll share with you NVIDIA technical chart. Why? Because we know that NVIDIA has a significant influence over the Nasdaq 100, and especially on the Nasdaq 100, pardon me, because it has a higher weightage inside the Nasdaq 100 versus the S&P, which also has a significant weightage as well, as NVIDIA now is the third biggest weighted stocks in the S&P 500. So what we could see over here is that yes, despite this negative 1.91%, we still need to analyze its technical chart, whether is it still holding on to some supports level, and how the price action on its price action candle actually behaved yesterday. So that will come a bit later once I do the intraday technical outlook on the Nasdaq 100. All right. So in the FX market, I would say it's a rather mixed bag. So if you look at the FX market by looking at the dollar index over here very quickly, so the dollar index yesterday went down slightly lower. Okay, 1 minute now. Let me expand the chart. It's been frozen a few seconds. Okay. Gosh, it's still very slow. Okay, good. So if you look at the dollar index yesterday, is down slightly, negative 0.1 12% with this little we call it black little candlestick over here. For those who knows about candlestick, it's like a bearish we call it hanging man, and it's coming very close to the upper limit of the range resistance at 106.35 or 106.37. So what's 106.37 over here is the swing high area of 16th of April and 2nd of May, and also conferencing with the descending trend line that I drew from 4th of October last year that has been capping previous rebound on the dollar index. All right, and but it still remains kind of supported right at the this slightly tighter. Yeah, let me push it early here. Yeah, this 50-day and the 20-day moving average that is converging to act as a singular support level at 105.24. All right, so it's more like a sideways range. So now it's hitting the top of the sideways range over here. And what's interesting over here is that during the start of Asia session, we see a slight push up in the dollar index as the US presidential debate ranges on. So later I'll touch more about the US presidential debate that has only just ended about 10 minutes ago between Biden and Trump. All right, then what we could see over here is that the dollar index, the strength of the yesterday's weakness of the dollar index, slight minor weakness of the dollar index, has been more or less being seen in the further we call it the US 10-year Treasury yield reacting negatively off from the 20-day and the 200-day moving average that is acting as a resistance at 4.34% over here. Notice the 10-year. So this was actually the sell-off that's seen yesterday. So think of it that it seems to us that the intermarket dynamics, the traditional intermarket dynamics that took shape that happened in the past, where we see a weaker dollar that is being caused by also a weaker US 10-year Treasury yield, is coming back into the markets again. But do not forget over here, this dynamic can change next week. Why? Because of this ongoing geopolitical risk event that is taking shape out of this weekend in Eurozone, where this Saturday, or this Sunday, we will have the first round of the France localized parliamentary election that could, over the weekend, then spill over to next week, early next week, that could impact dollar and the 10-year US Treasury. So let's say if Le Pen's party, the far right National Rally Party, or even the far left party, the socialists, either one of them managed to gain a significant foothold in the France localized parliamentary election. That means, i.e., their policies will likely widen the budget deficit of the French economy, which in turn could translate to a higher credit risk of holding French sovereign government bond, which have a negative adverse risk-off effect in Eurozone. So that could actually drag down the euro dollar and push up the dollar strength. And but once we see the push up in dollar strength, that could actually break down the traditional we call it a direct correlation with the US 10-year Treasury yield, because a geopolitical risk of event could lead to also safe haven flow back to US Treasury as well. So that could be a possibility where we start to see US dollar getting strong, potentially, followed by the US 10-year Treasury yield coming down as well. That what has happened in this period over here during 11th of June all the way to 18th of June, where the US 10-year Treasury came down, but due to that rising, we call it significant power that is being gained by the far right nationalistic party in Europe, that causes a safe haven bid towards US Treasury, in turn also lead to a safe haven bid on the US dollar. Okay, so that's what we call demand of US Treasury push down the US 10-year Treasury yield, demand in US Treasury lead to a firmer US dollar. So that was taken shape in the last 1.5 week ago. Okay, something to bear in mind of, okay, in terms of the dynamic nature of intermarket relationship between cross asset classes. Okay, but nevertheless, what we could see, we still got to respect that this resistance level hasn't been broken out at 4.34%. So even though in today's Asia session we do see a little push up in the US 10-year Treasury yield, but it didn't surpass above the 4.34%. All right. Then what's interesting over here is that during the Asia session, we start to see a push up in the US, the dollar against the yen at around the 161.10 level. But right now, it seems to us that it's getting a bit hesitant to actually did a break above the 1610 level. Okay, let's go very quickly look at the dollar yen. So if you look at the dollar yen now, it's actually try to back down. This is a 5-day rolling performance. So initially the dollar yen peaked somewhere around at the intraday high of 0.96%. Then the dollar yen now starts to back down again. Okay, so later I'll show the technical outlook chart of the dollar yen. So you look at the dollar yen is quoting right now at 160.87. So yesterday we do have a key short-term pivotal resistance. For those who follow our daily dose yesterday, I did mention 161.10 is a key resistance level to look out for, which indeed the dollar yen this morning it tested it, but failed to have a proper breakout above this level. And the reason why it fails to break out above this level, because there is some data out there that is actually supporting potential BOJ path of normalizing its decades past of accommodative monetary policy. That means they keep the hopes of another potential BOJ hikes to come into 2024. Is two key Japanese data that is showing signs of improvement that supports BOJ upcoming hike, at least either in July or September before 2024 ends. So this data, the first data I'll highlight is early this morning, which is the industrial production over here in Japan. Okay, where is it? Yeah, this is the preliminary figure for May, the year on year. So year on year, industrial production managed to inch back to positive territory for May at 0.3% year on year, away from the previous negative 1.8% year on year printed in April. And if you look at from a non-seasonal factor, that means on a month-on-month basis factor, it actually inched up 2.8%, also way above negative 0.9% that was printed in April, and also way above the expectation of 2%. So if you look at from the year-on-year basis, the industrial production in Japan, it seems to us that the confidence of the manufacturers seems to be coming back into the picture. All right, it starts to actually inch back upwards to positive territory. Okay, but what's most important over here is the inflation rate coming out from the leading Tokyo area CPI data. So for those who actually first time heard about this Tokyo CPI or first time join me in the daily dose, okay, I will tend to highlight the Tokyo CPI data as well, which is out around 3 to 4 weeks earlier than the nationwide Japan CPI data. So the government statistics boards in Japan will release the Tokyo CPI data first for the month of June. Then around 3 to 4 weeks later, they will release the nationwide Japan CPI data for the month of June. So market watchers or traders will tend to use the Tokyo CPI, something like a leading sign of economic indicator to gauge the inflationary trend in Japan. All right, so that's why the Tokyo CPI data release is important. So if you look at the Tokyo data release, both the core and the core CPI data. So bear in mind, Japan is a bit slightly different in how they categorize their CPI. They do have the core CPI, but the core CPI is only excluding energy. Then if you want to exclude food and energy, they will have the core CPI. But if you look at both of them, both the core and the core CPI and the core CPI has seems to turn around in a corner after the last few months of rather deceleration trend. So let's start with the core CPI first. So core CPI managed to move back up to 2% at 2.1%, above 1.9% that was recorded in the month of May, and slightly above expectation of 2%. So let's look at the trend of the core CPI. All right, so let me push it down a 5-year trend. Okay, so what you could see over here, previously there was signs of a deceleration at the start of February all the way down to April at 1.6, and from April onwards low of 1.6. It slowly inched higher to May 1.9, and now it's back at 2.1%. So it seems to me that this particular deceleration trend from this January all the way down to April 2024 seems to have stopped, and there could be a normalization of inflationary pressure hitting back to Japan, allowing it to actually stabilize at the 2% level that what's BOJ want, in order for them to get more confident to continue their baby steps of what I call policy normalization. That means the next step will be another very small incremental interest rate hike coming in Japan. That's the core CPI. So how about the core CPI that is much more so-called monitored by the Bank of Japan, because they actually strip out food prices and energy. Okay, going forward, where's the core CPI? Okay, sorry, it's a bit lagging. My screen suddenly just froze. Okay, over here. Okay, this is the one. Okay, core CPI. Oh gosh, it's hang again. Okay, over here. So if you look at the 5-year trend, okay, it seems to us that it also starts to tick up as well. Okay, from 1.2% year on year in May, then now up to 1.4% in June. All right, so that actually explained to us why, despite the fact that there was an initial push up in the dollar strength at the start of the Asia session during the onset of the first US presidential election that went live earlier ago, but the dollar yen refused to break above the 160 110 level. Now it's back at 160.87 because of this two key Japanese data that is actually supporting not a deflationary trend in Japan, but rather inflationary trend in Japan may stabilize going forward the next few months. That could actually support at least one interest rate cut by BOJ before 2024 end. So that's kind of supporting the yen, at least in the short term intraday basis for today. All right, so that's the explanation of that particular fundamentals that I want to share with you all. So other than that, now let's quickly jump into the US presidential debate for just a while ago. So for those who actually wants to actually have a quick snapshot over here, based on the current debate that's going on, based on betting markets, because this particular site, someone posted on Twitter, so this towards the end of the debate over here. So they actually get it from a live betting website called Predict It, PREDICT. But unfortunately, if you Google it in Singapore-based browser, our browser actually block it because it's a live betting website. But this particular live betting website, they can actually access it from Bloomberg. So if you could go Bloomberg, if you have a Bloomberg terminal or someone has a Bloomberg terminal, you just type in WSL election go. They give you live. Okay, so right now after the end of the presidential debate, it seems to me that the betting markets are actually looking for Donald Trump to lead as a president, if we are talking about based on the betting markets price action movement. A very stark movement over here. So previously it was stabilized. Then after the debate, you see Trump leading by 59 and Biden just go all the way down to 38, even though it came back a fair bit over here. So just a while ago, I do watch the debate between Trump and Biden. So it seems to me that Trump has a much more forceful and genetic tonality over Biden, who is he sounded I think he just unfortunately caught a cold, because he do have a very he sound very raspy and pretty much unclear, and during his speeches he also stumbled here and there as well when the commentator asked him to comment on his achievement, especially on the jobs number. So based on the speech I heard earlier on, Donald Trump is going to actually advocate on a protectionism policy. That means, i.e., he's still looking to make America great again. He wants to actually go forward to his proposed tariffs against China and against the rest of the world. So at the moment in time, Donald Trump actually proposes 60% additional tariffs on all China exports going into US, and the rest of the world additional 10% tariffs. All right, so not only in China but also the other portion of that. So it seems to us that Donald Trump is advocating a potential trade war 2.0 with China and perhaps against some parts of the world. So how does it impact on the various markets? So right now what we share with you is a intermarket dynamics based on Trump's potential protectionism policy, if that could happen. All right, and given the fact that Trump, the betting odds seems to be favoring Trump right now after the outcome of the first presidential election debate that has taken shape about 10 or 20 minutes ago. So now this particular chart I'm going to share with you all is this chart over here. is I will plot the dollar against the dollar index, okay, using the dollar index as a general view of the dollar movement. Okay, so the top chart over here is the US dollar index. So this is a weekly chart of the dollar index. All right, it's a long-term chart. And this little dotted line, this dotted line here on 22nd of January for the week 2018, this is the start of the US-China trade war, the real start of it. That means they kickstarted. Then this is where you see at the start of the US-China trade war, the dollar actually strengthened, okay, throughout the period until where we come to the onset of COVID. That's around middle of March 2020, where we start to see the COVID-19 shock to the global economy, and that's also including US. The Fed reintroduced QE measure to counter the negative adverse effect of the COVID pandemic. So that thereafter, because the Fed cut rates aggressively and buy up bonds, that drive the dollar strength dissipated and starts to go all the way down and remove off the entire dollar strength that was again during the start of the US-China trade war during Trump's presidency during Trump president's era in January 2018 all the way to 2000 to early 2019. Then we see it pumping down. And what's interesting over here is that it starts to form a little mini base as well, and the market actually rallied ahead of the start of the Fed interest rate hike cycle. So that's in 14th of March 2022, the week of 14th of March 2022. So that's the start of the US Federal Reserve interest rate hike cycle. Then after they keep hiking, the US dollar gains strength as well. So prior to the bullish basing breakout, the market broke ahead of the US federal interest rate hikes because inflation starts to pick up during this point in time due to the Ukraine Russia war as well. That is kind of putting a strain on global supply chain. Then thereafter, what you see over here, that you hit a peak over here at this point in time, and the dollar starts to actually deflate or decelerate in terms of their trend. And prior to that, after that, we start to see a pause in the interest rate hike cycle in the week of 24th of July 2023 over here. Okay, so then thereafter, we see it go sideways thereafter. Okay, just go sideways. And at the end of this area here, in 11 December, the week of 11 December 2023, we start to see the Fed issue that dovish pivot towards the end of last year, where Powell actually guided the market saying that potentially this year there could be a start of the interest rate hike cut cycle, cut cycle, where market participants price in close to 6 interest rate cuts for 2024. That was at the end of last year. We call it the Fed dovish pivot that led the dollar strength to get weaker. But then as more data start to come in, the Fed dovish pivot starts to diminish. And right now, market is only looking at either 1 interest rate cut or even the best 2 interest rate cut before 2024 ends, based on the latest, we call it public speeches and the guidance coming out from the US Federal Reserve. So I don't want to explain much more in detail, but it seems to us that in terms of a technical analysis perspective, this sideways movement is still doing a potential major bottoming formation, as we could see over here. Okay, so this major bottoming formation could potentially kickstart if Trump were to actually kickstart another US-China trade war 2.0, and it may get involved with much more nation this time around, because he wants to also impose tariff on other products coming from other parts of the world, not including China. So if he could kickstart another potential US-China trade war, that could also lead to a rise in the US Treasury yield as well. Okay, do not forget, Trump itself also advocate for a lot of corporate tax cut. So that could actually strain the US budget deficit and increase the premium on US treasuries. That means international investors will demand a higher premium to hold US treasury as well. So that could actually increase the US treasury yield against the rest of the world. But what's important technically over here is that before that potential increase in the US Treasury yield against the rest of the world, due to Trump's, we call it extravagant potential corporate tax cut, the US Treasury 2-year against the rest of the world, that means I get an average from Germany, UK, Japan, Canada, Swiss, AU, and China, has already broke out from a major symmetrical triangle range configuration in March 2024. But bear in mind, this is more of a longer term picture. It will not happen overnight, multi-week. It will just take shape in a multi-month perspective. And the key level to watch, right, for a potential breakout in the US dollar strength will be at 106.65 on the US dollar index. And that strength in the US dollar could potentially translate to a breakout in the Chinese yuan as well. That means the dollar against the Chinese yuan. So if this red line here start to tick up higher, that means the dollar is strengthening against the Chinese yuan. And the dollar also strengthening against the Chinese yuan during the start of the US-China trade war as well. And right now, what you could see over here is that the Chinese yuan is still being controlled by the PBOC, which is the China Central Bank, because they do not want it to move so much. That means they set a midpoint range every day. It's either going up or going down based on general dollar strength, and they could only allow it to fluctuate on the daily basis, either plus 2% away from the midpoint range or negative 2% from the midpoint range. So it's like a dirty peg, a dirty fixed peg. So the key resistance to watch out for on the dollar CNH will be at 7.3650. So take this level as an equivalent level of the 106.65 on the dollar index. So if the dollar yuan starts to break above, the dollar Chinese yuan start to break above 7.3650, it could potentially kickstart another round of severe China yuan weakness. So once China yuan weakness come into the picture, we know that China is an exporter. They require to weaken the yen if to actually offset any potential tariff to make their goods and services looks cheaper against the rest of the world. That could actually evoke a potential currency war as well in other countries that are dependent on their export to drive growth. One of them will be South Korea, Taiwan, and eventually it will lead to also weaker Sing dollar as well, given that Singapore, we still have the export sector as our one of our pillar of economic growth. So once that's happened, that could also potentially lead to what I call capital outflows from these countries' stock market, and it could also drive up volatility globally by the CBOE VIX index that is still being depressed at this juncture. So if you look at the US start of the US trade war in January 2018, the VIX on the average tends to actually see periodic period of spiking up over here. This is the start of the US-China trade war during Trump's period of presidency. You see there is a periodic spike up in the VIX index. So we see VIX index, if a spike up in VIX index, that actually encourages increased negative volatility in the US stock market. That means, i.e., higher risk of a more significant correction coming into the US stock market going forward. That means we are talking about perhaps next year. And if you look at right now, why? Because the risk of the VIX is at an extreme low level, and volatility, positive volatility is solely, negative volatility is getting curbed on the downside. So it's now like a compressed spring waiting to actually spiral upwards if there is an adverse macro event taking shape. All right, so that's for now on the impact of this current US presidential election, that the betting markets is favoring Trump, but Trump policy doesn't seem to be helping a very nice risk on impact on the market. Okay, so that's all for now. I'll stop over here. Okay, so and then bear in mind, this chart I share with you is a long-term picture. It's not an intraday chart, but this is a weekly chart. So what could take shape in terms of time horizon? It will be a multi-month perspective, not a multi-day or intraday perspective over here. All right, so with that, now that sums up the fundamentals and the intermarket dynamics. Interesting one that I want to share with you all that is taking shape right now on the markets. So with that, now let us jump straight to the short-term intraday outlook. So the share now is the short-term intraday outlook on the cross asset classes, starting from the FX market. All right, over here. So with that, let me expand my screen first so that all of you all could see clearer. Okay, let us start with the dollar major against the European currency. So let us start with the euro dollar. So no change on the euro dollar as per se, yesterday we do have, due to mixed element, we have a neutrality sense. That means sideway between this neutrality range of 0.720 and 1.0656. Okay, so it's still hover within our range. Yesterday price tried to break above at 0.720 before backing back down throughout the US session, and today's Asia session as well. Still keep this range intact for today's intraday session at 1.072, 1.0656. Okay, only a breakdown below 1.0656 will kind of trigger a short-term intraday bearish weakness on the euro dollar to kind of expose the next near-term support at 1.0620, 1.06 figure level, which is the minor swing low area of this area here, 16th of April and 19th of April. All right, so that's for the euro dollar. The sterling dollar seems to be holding on at a better shape compared to the euro dollar as it tries to play around with the 50-day moving average. Okay, yesterday it tried to break above the 50-day moving average, hit the first resistance, but it didn't hit the second resistance at 1.27 figure before trading back down again. All right, but what's interesting over here, there is some form of a bullish candlestick formation. All right, let me explain. Okay, so taking into account these three candles from the start of the Asia session at 8 a.m. all the way down towards 11 a.m. Singapore time. All right, this three little candle is considered as a bullish morning star candlestick. Why? Long bearish candle, small little candle, a doji, formed by a positive candle where the candlestick body, the white candlestick body, is larger than the candlestick of the doji. So that's called a morning star, a bullish morning star. So indicating to us that this particular movement that was seen during the the later part of the US session, where there was a sell-off in early Asia session, seems to be negated at this juncture. Okay, based on the current hourly price action on the sterling pound, the cable, that means the cable against the dollar. So with that, still no change, right? Yesterday we still do have this 1.2620, 1.26 figure as my short-term pivotal support. So I'll still use this level as my short-term pivotal support, except that the first resistance to watch I will adjust it slightly higher to yesterday's swing high area during the start of the US session before that minor sell-off took shape throughout the entire US session. Okay, gosh, give me a minute. Sorry, I think my screen is frozen again. Okay, hopefully this time around it will not froze on me. Oh gosh, what the hell is this? Okay, I don't want this. Let me. Okay, good. Over here at 1.2670. All right, so the first resistance will be at this 1.2670. Above 1.2670, then we may see another exposure at the 1.27 figure level on the sterling dollar. So but however, if we start to see an hourly close below 1.26 figure level, then this short-term intraday bullish outlook will be invalidated to kickstart another round of weakness, short-term weakness or intraday weakness on the sterling dollar to expose the 200-day moving average that is so acting as a resistance, as a support, pardon me, that's acting as a support, my mistake, as a support at 1.2565 level. All right, over here. So that is confluencing with the former minor swing high of 7th of May and 14th of May. All right, this level here. Okay, so that's for the sterling dollar key levels to look out for today. Now moving on will be the dollar major pair against the Asia Pacific currency. Let us start with the dollar yen first over here. So the dollar yen right now is still holding below that 160 110 short-term pivotal support level, pivotal, pardon me, 161.10 short-term pivotal resistance level. All right, so with that over here, this is the pivotal resistance level that is still intact. But what I want over here is that I need to have a kind of a put away that a downside trigger level to maintain the short-term intraday bearish bias on the dollar yen. So the downside trigger level that I will have for today will be yesterday's US Asia session low. Okay, Hopefully, why is it keep hanging? Okay, seems to be very slow now. Oh gosh. Okay, this level here. Okay, at 160. Okay, what the hell? Okay, 1.6030. So this is something like a downside trigger level. So a breakdown below 16030 may expose the next near-term support at 159.90, followed by 159.10 level. All right. So I do have a additional downside trigger level that I added on uh, for today for the dollar yen. But however, if we start to see a clear breakout above 16110, that means another hourly close above 16110, then we got to respect the bullish price action of the dollar yen to see the impulsive up move resume to take a hit on the next near-term resistance at 16180. Above it follows 16240 next, which is correspond to the upper limit of this minor newly involved ascending channel from the low of 12th of June. Okay, so that's for the dollar yen. So now let us now go to the Aussie dollar. So Aussie dollar, a bit of volatile movement today, because yesterday we have a bullish bias above the 20-day moving average. The resistance that we highlight was 66.70 first resistance. Only this level break, then we may see 67.10. So yesterday it managed to hit the first resistance. Then thereafter, it did that pullback and sell off during the Asia session today and back below the 20-day moving average as well. So I could see over here is that the couple of days on the Aussie dollar is trading sideways. Why? Because there's no trend on the Aussie dollar. Because if you look at the daily chart on the Aussie dollar, is still trapped within this symmetrical triangle range configuration ever since from the low of 13th of October and 3rd of February. So that actually explained to us the very choppy sideways movement even on the intraday basis as well. Because on the higher time frame, there is no clear signs of a trending phase at this juncture. So with that, let us now go to the hourly chart. So what's interesting over here is that despite that sell-off earlier in Asia session over here, it managed to find a bit of support. It bounces, holding exactly right at the 50-day moving average. All right, and the RSI also managed to tick up after hitting slightly at the oversold region. Very similar what happened it did over here during the 14th of June. It hit, then thereafter the price action slowly inch up higher, all right, to the top of the range. Okay, so this similar price movement seems to be taking shape against by referencing the hourly RSI with previous past price action movement on the intraday basis or on the hourly chart of the Aussie dollar. So with that, right, since it's coming to a 50-day moving average that is acting as a support with a positive observation that is being seen on the hourly RSI, I will use 6610 as my short-term pivotal support for today. Okay, so if this level didn't break, potentially recapturing of 6640 again, which is the close to the 20-day moving average that was triggered down today, that formed this long black candle, long black hourly candle, the high of the candle at 6640. A break above 6640 potentially sees a revival of at least a short-term push-up towards the upper limit of that symmetrical triangle range configuration. For sure, on the intraday basis, the next resistance after 6640 will be at 6670 that was being rejected yesterday on the Aussie dollar boost. Okay, so these are the two key short-term resistance to watch on the intraday basis for today. But however, if you start to see an hourly close below 6610, then forget about this potential recovery. What we could see over here is that we got to respect the price action where it potentially dictate more short-term weakness on the intraday basis for the Aussie dollar, still within that symmetrical triangle range configuration. The next near-term support to watch will be at 65.90, 65.80, which is the minor swing low of this 17th of June and 10th of June. But suddenly, if we start to see a spike down below 65.80, then it could expose the 200-day moving average at 65.50. So what 65.50 over here is the 200-day moving average that is confluencing with the congestion area minor one from 26th of April to 29th of April. Okay, so that sums up the short-term intraday technical outlook on the major FX pairs. So now let us move to the major stock indices. All right, starting with the Asia Pacific indices, let's start with the Hong Kong 33. So very interestingly, on the Hong Kong 33, at the start of this week, we were bearish, and the price action yesterday hit our support level at 17,600 level. All right, so 17,600 level was this minor swing low here of 7th of May, and upon hitting this level and during the Asia session, it started to form a bullish hourly candlestick. All right, so prior to this bullish hourly candlestick, price action did a lower low, but however, the hourly RSI managed to shape a bullish divergence. So what we could see over here, given that the support is being met over here with a bullish divergence, very likely the Hong Kong 33 or the Hang Seng Index could be forming an intraday, I stress again, it's an intraday outlook. So it could be forming an intraday bullish reversal scenario taking shape right here, right now on the Hong Kong 33. So with that positive price action, I'm not so confident of keeping that bearish bias, intraday bearish bias intact on the Hong Kong 33. So instead for today, I will flip to a short-term intraday bullish bias given the positive intraday technical element that I highlighted earlier on, using 17,600 as my short-term pivotal support level, a break above 17,940. So that's the first resistance level to watch. Why is it important? Because that is also give way to that long bearish candlestick formation sentiment psychologically after the prior breakdown of 17,940. So this could be also an important first resistance in terms of psychological impact that the bulls got to surpass before talking about exposing the next near-term resistance at 18,180 on the intraday basis. So what's 18,180? Minor swing high area of 25th of June and 26th of June that confluences with the 50-day and the 20-day moving average that is also acting as a resistance at this similar level of 18,180 as well. Then on the flip side, if we start to see an hourly breakdown with a close below 17,600, then this intraday bullish reversal scenario will be invalidated to see the continuation of this corrective decline to expose the next support area at 17,460, 17,460, which is the minor swing high former minus 6 on 25th of April, and as well as the golden ratio, the 61.8 Fibo retracement of that previous medium-term rally from 19th of April all the way up to 17th of May at 60, also conversing with the 61.8%. But however, if we start to see a clear, a very drastic spike down below 17,460, then this decline may extend to retest the 200-day moving average that is also acting as a support area at this 17,170, which is the former minor swing high of 13th of March and 10th of April. All right, so that's for the Hong Kong 33. Moving on will be the Nikkei 225 or the Japan 225. So still recall the Nikkei 225 yesterday, we do have a bullish bias because price actually managed to hold at the 39,230 short-term pivotal support that we highlighted earlier, which indeed is shaped that bullish short-term intraday bullish reversal. It did shape up higher high, higher low, and almost come close to the resistance that we highlight, 39,880, before doing hourly pullback or the two-hour pullback right now that we are seeing as we are speaking. So one thing positive over here is that despite the fact that the RSI is almost hitting the overbought zone, but it didn't shape any bearish divergence because price action of the RSI continued to shape a higher high in line with the higher high in the raw price action of the Japan 225, i.e. Nikkei 225. So with that, we'll still maintain that short-term pivotal support at 39,230. I don't want to tie it so tight to this support at 39,440 because it hasn't surpassed 39,880 level. So still maintain that short-term bullish bias on the Japan 225 with 39,230 as a short-term pivotal support level. First resistance for sure 39,880. A breakout above it exposes the next resistance at 40,230. We also confluence with the this rising ascending channel that I drew. Okay, it's hang. I don't know why. Gosh, so slow. Okay. Oh man. Okay, from the low of 19th of April. Okay, only a breakdown and hourly close below 39,230 will invalidate this intraday bullish bias on the Japan 225 to see another round of choppy corrective decline scenario on a minor time frame basis to re-expose or retest the rising 20-day moving average that is so acting closely as a support at 38,750. A breakdown below it sees the upward sloping that is turning up 50-day moving average as well. That's also acting close to a graphical support at 38,460. All right. So let us move on to the German DAX or the German 30. So bear in mind with the upcoming French presidential election, that first round of the French not president, the French parliamentary election, pardon me about tongue twisting, the first round of the French parliamentary election that is to be held on this Sunday. Still no change, right? It's going to trade sideways below the 18,380 short-term pivotal resistance that we highlighted since the start of this week. All right. Also the 20 and the 50-day moving average as well, I think, as a resistance. So this level here still will be the short-term pivotal resistance level on the German 30 or the German DAX. First support level to watch will be 18,085 that has held since last Friday. Okay, only a breakdown below 18,085 will re-expose the 17,990 slash 17,930 next near-term support level, which is the swing low of 14th of June and 17th of June. Only an hourly close above 18,380 will invalidate today's intraday bearish bias on the German 30 to see extension of that rebound towards the next resistance at 18,520. Above it may expose 18,640 slash 18,685 next on the German 30 index or the German DAX. Now, moving on will be the US major stock indices. So let us start with the Dow Jones Industrial Average. Okay, whoops, sorry, it's a bit hanging over here. No, why? Okay, US Wall Street 30. So US Wall Street 30 continues to bounce as expected yesterday. 39,090 slash 38,945. The excess was the short-term pivotal support level that we highlighted. And bear in mind, the 20-day and the 50-day moving average continues to inch up as well. So kind of supporting a potential ongoing short-term uptrend phase that has started to evolve in the US Wall Street 30 or the Dow Jones Industrial Average. So no change. The first resistance is at 39,290 because that was being tested yesterday before trading sideways. So a breakout above 39,290 potentially sees a retest on the 25th of June swing high, which is this week high at 39,600 next on the intraday basis for today. Only an hourly close below 38,945 will invalidate today's intraday bullish bias on the US Wall Street 30 to see another round of a choppy minor corrective decline to retest the next near-term support at 38,730. A breakdown below 38,730 exposes 38,560 slash 38,420, which is so confluencing with this ascending trend line that I drew from the low of 30th of May. All right, so now let us move on to the Nasdaq 100. So before I talk about Nasdaq 100, let's look at the technical chart of NVIDIA. Why? Because NVIDIA is an important, significant component in the Nasdaq 100 that could influence the price action of the Nasdaq 100. So if you look at yesterday's price action of the NVIDIA, it still managed to hold right at the rising 20-day moving average. Okay, right after this positive candlestick that has taken shape on the 25th of June, where it gap up at the opening price. And so far, the price action, yesterday closing price action on NVIDIA managed to actually close near the midpoint of this bullish candle. Okay, this significant daily bullish candle that was formed on the 25th of June. So given these two positive price element of NVIDIA that is still showing to us right now based on yesterday's current price action, we will still maintain that bullish bias on the Nasdaq 100 that we have for yesterday. So on the Nasdaq 100 chart, if you look at it, it's very clearly tracing up a series of higher high and higher low, hit the first resistance already at 19,840, and right now looking for a test at the next resistance at 19,990. So given that it already hit the first resistance yesterday, so for today, right, I will tighten the short-term pivotal support for today to maintain this ongoing short-term intraday bullish bias on the Nasdaq 100. Okay, to this level here, let me highlight. Yep, this is the one. Okay, so let me copy this, let me paste it, and let me change it. So it will be 19,645. Okay. Okay, 645. So this will be the next support level. No longer a pivot. Okay, so today we will have a Titan key short-term pivotal support on the Nasdaq 100 at 19,645. Still maintains the intraday bullish bias on the Nasdaq 100 from a very short-term perspective. Next resistance 19,990. Above it, we'll see a retest of the all-time high area at 20,120/20,155. Next, above it, sees the next resistance coming in 20,260, which is defined by a Fibo extension cluster level. However, hourly close below 19,645 will negates today's bullish intraday bullish bias to see a slide to retest the rising 20-day moving average that is acting as a support at 19,480. A breakdown below it sees a deeper slide towards 19,240 next. All right, so that sums up the short-term intraday outlook on the major stock indices. Now, before that, let us now quickly go to the commodities, starting with gold XAU/USD. So for gold price, yesterday it managed to did a bounce over here. It bounced up, but can't break above the resistance that we highlighted at 2,326 before backing back down again. And if you look at the hourly RSI, it starts to shape a lower low as well, lower high, pardon me, not lower low, lower high after hitting the overbought level yesterday after the spike up. All right, so indicate to us that momentum is not so bullish after all, despite the test of that moving the resistance that the 2,326 short-term pivotal resistance that we highlighted. So I'll give a bit of excess yesterday because yesterday it actually went up to a high of 2,331. So I kind of slash it over here for today. Give me a minute. All right, 331. Okay, so 2,326/excess 331 still be my short-term pivotal resistance that we have on the gold XAU/USD. Still maintain that short-term intraday bearish bias on this gold XAU/USD. The first support level to watch out for today on an intraday basis, okay, will be at this week minor swing low that was made on Wednesday at 2,300 level. Okay, it's 2,296, so I round up to 2,300 level. A break below 2,300 level exposes the next support area at 2,280/2,270, which is the minor swing low of 3rd of May, 1st of May, and as well as this area here, 4th April. Okay, only an hourly close above 2,331 level will invalidate today's intraday bearish bias to see a continuation of the push up or a short-term intraday recovery towards 2,344, and above it potentially could see 2,365, which is also the minor swing high area of 21st of June. All right, that was printed earlier on. So that's the outlook, short-term intraday outlook for gold XAU/USD. So still maintaining that short-term intraday bearish bias as long as 2,326 excess/2,331 short-term pivotal resistance holds for now. Then moving on, next we will have this movement of WTI crude oil over here. So West Texas crude oil yesterday after refusing to actually break below the 80-60 level support, it broke above 82.20. So that was our short-term pivotal resistance that we have. So we got to respect the price action. It seems to us that this ongoing rebound that has taken shape since the start of this month is continuing its strength going forward. So with that, right, I will use 80-60 because for sure this is a very clear support level that managed to help since 19th of June, and even in the last 2 days it refused to break down below it, all right, and continues to push up. Okay, so 80-60 short-term pivotal support level for West Texas Oil flipped to a short-term intraday bullish bias on it. First resistance to watch 82.90, a breakout above it exposes 84.40 next. Only an hourly close below 80.60 will negate this or invalidate today's intraday bullish bias on WTI crude and see the revival of that minor corrective decline to take shape again, to see a retest of that 50 and the 200-day moving average, and right now also the rising 20-day moving average that is acting as a as the correspond or confluencing with the next near-term support zone at 79.45/78.90. Only a breakdown below 78.90 will see a deeper pullback to retest the swing low of 13th of June and 14th of June, acting as the next near-term support at 77.60 next. And 79.60, if we do the Fibo retracement of that entire current ongoing rebound from the start of this month, or 14th of June, you push it up to the current intraday high, that also correspond to the 50% Fibo retracement as well. Okay, so with that, that sum up today's short-term intraday outlook across the major cross asset classes. So before we go, let's take a look at the calendar. What are the key events to look out for today? So for today will be Friday. So what we could see over here is that we do have a slew of inflation rate preliminary readings out from key Eurozone countries. So France will release is a flash inflation rate preliminary reading for the month of June out at 2:45 p.m. for today, and thereafter at 6 p.m. we do have one Federal Reserve official speaking. Fed Birking will be speaking as well, so it's kind of important to hear a speech. Why? Because Birking is one of the guys that is not belongs to the dovish camp. Okay, so instead he's more on the hawkish side of the story. So but before that, after that, then we have the all important core PCE price index. So it's another inflation metrics where the Fed tends to pay more close attention than the CPI index. So that will come out before the start of the US stock market session opens at 8:30 p.m. Singapore time. All right, so market expectation, right, for the core PCE price index over here, the year on year, they're expecting a further kind of deceleration to 2.6% year on year from 2.8% year on year printed in the previous month of April. Then thereafter, it will be a rather quiet session because this one more or less the same because than 2 weeks ago. So the final figure of the University of Michigan consumer sentiment data will be finalized for the month of June at 10 p.m. The results will be released at 10 p.m. Singapore time. Good to take a look at it, especially to see whether the finalized number has it skewed that much from the preliminary figure that was flashed out 2 weeks ago. All right, so that should sum up today's key session. But before I go, we do have another Fed official speaking, Fed Bowman speaking at 12 a.m. Singapore time later today, in the Saturday, all right, during Saturday session. All right, so with that, that sums up today's daily dose of market insights, pardon me. So I wish you all a great day ahead and a good restful weekend. And bear in mind, I will be away from my desk on next Monday. So on next Monday, on the 1st of July, there will be no daily dose, and daily dose will resume again on the Tuesday, 2nd of July. So with that, we shall speak soon and have a great day and a restful weekend ahead. Thank you.